Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about NextDecade, recapping their Q4 2023 earnings, and also talking about sort of what's next for the company, the current progress that they've made, and how I think they're going to be funding all of this. And I have a discounted cash flow valuation model that I'm going to be walking through that I personally am using to sort of get an idea of what fair value is for the stock right now. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in NextDecade, so this video should be for your entertainment purposes only because I can be wrong about everything I say in this video. You need to do your own research before making any investment decisions. All right, so as I mentioned, this is NextDecade. I'll give you the 15-second summary if you're not familiar with the company. Then I'm going to get into some of the details. So they are a hopeful LNG exporter, US based, down in Texas. They have made their final investment decision on trains 1 through 3, which they call phase 1, which will be 17.6 million tons per year of LNG export capacity. They have 16.2 of that, I think, already signed away under sales and purchase agreements for that LNG, and they are constructing the facility right now. They just reached the FID decision in middle of 2023, and so they're very early on in this process. It's going to take another 3, 4, 5 years to actually construct the liquefaction facility, and that is the point at which it will become operational. Between now and then, the company is just building this out, and really, they're not building it themselves. They have a contractor, Bechtel, that is actually doing the building for them, and so that is the current state of the company. And so hopefully that gives you at least some context if you weren't already familiar with the company. I know a lot of my viewers are. This is a company that I've covered on my channel quite a bit in the past. I've been holding on this company as an investment for 4 or 5 years now, somewhere in that vicinity. So one thing I will mention just right off the bat, I'm going to be focusing strictly on the Rio Grande LNG project today. They also have another, division or half of the company that is their next carbon solutions. They did. I think it started a pilot with one company. I don't know, a year or two ago. It's been a while since they did that, and I haven't heard any updates on that since then. So, and there really wasn't anything even in Q4. So I'm just not going to talk about that part of the company at all. And when I go through my valuation model later, the next carbon solutions business is just not at all included, other than to say that it potentially is something where they're spending money right now that they have to fund on the next decade level. But I am not expecting any revenue from that portion of the business. So that is something that is generally not factored into the valuation model that I will have when I get to that point. So, all right. When let me go through actual, the Q4 for NextDecade, and as I mentioned, up front, they are getting construction done on this. Bechtel is actually building it. They've contracted with Bechtel, signed all the agreements, and orchestrate all the finances stuff. Hi, Walkaza, thanks for hopping on the stream. And so that's the current progress, right? NextDecade itself is instead focused on getting a contract with Bechtel, getting an EPC contract in place for train 4 of this facility. As I mentioned, it's a 5-train facility. They've already got a contract that's underway where they're building trains 1 through 3. And that first contract I should mention for that phase 1 also includes some common site infrastructure for the entire 5-train LNG export facility. And so one of the interesting things about that, just as a quick tangent, the cost per ton for actual exporting, the construction cost is lower for trains 4 and 5 than it is for trains 1 through 3, because trains 1 through 3 also lump in some common site infrastructure that's going to be needed no matter what, and is going to cover all 5 trains. So that is one interesting thing as we look towards the future, and why some of the future trains might be a little more lucrative than the first 3. And so, as I mentioned, the company is actually focused on I don't know where it's at. Yeah, they're focused on signing agreements, both on signing all the agreements they need in order to get the next train 4, actually, to a final investment decision, and where that is off and running and has its own timeline. So, as I mentioned, they have to actually get a contract in place with Bechtel and lock in the cost of that, and they plan to do that in H1 of this year, right by the end of June. And so that will be good to see, and it'll be interesting to see if they actually disclose what the final what the final price is before they make their FID, or if that we just kind of don't know. Because if I recall correctly, I think for trains 1 through 3, they didn't actually disclose the full costs until they actually made the final investment decision to go forward with everything. But they're working on that, and simultaneously they're also working on getting sales and purchase agreements from off-takers, from people to actually purchase the liquefied natural gas that train 4 would be producing. And if you're not deeply intimately familiar with the details of the company, they already have some, Total Energies, which is I think a French energy company, very large energy company. They already have purchase options for 1.5 million tons per year of the LNG from each of trains 4 and 5. And they were one of the large off-takers from trains 1 through 3. I think they took 5 or 6 million tons per year from those first 3 trains. I guess there's a slide that shows that. Someone here, maybe I already passed it. It has the table of all their off-takers. Oh, here it is. It's pretty far down here. And so you can see Total Energy, that's this last column here. They took 5.4 million tons per year from those first 3 trains. They were, I think, one of the last people to sign on and really kind of got the project for phase 1 over the finish line to where they got that final investment decision. But Total also, in doing that, got options to participate in 1.5 million tons per year from trains 4 and 5. And I think those trains are, I want to say 4.5 million tons per year, somewhere in that range, about 4.5 million tons per year in capacity, period. So, Total getting that 1.5 is actually pretty significant. And I think I saw somewhere, let's see if it's right. Where am I at? Working for train 4. That's not the slide that I was on. Oh man, I'm losing my place. This isn't good. Where's the slide about train? Oh, it's right here. Yeah, so they need an additional 3 million tons per year of contracted volumes for people to get the financing to move forward, right? That's what they need in order for the banks to say, yes, it looks like you've got enough sales and purchase agreements in place so that we are confident that you're going to have the cash flows, and we're happy to lend you some money in order to actually build this thing, because with what you've got contracted for, 15 years or 20 years on that amount of LNG, that looks like it's sufficient cash flows. We are satisfied that we will get paid back our money. And so that is what NextDecade is focused on right now. They also gave this details, and I don't recall if this is new or not. I didn't go back and look at all the future disclosures, but they called it out here that they are expecting to fund Train 4 with 75% debt and 25% equity. And so that's actually more debt and less equity than they did for Phase 1, which is, I think in the end, assuming everything works out, tends to be better for shareholders in the long term, because they had to give up less equity. Because NextDecade does not have cash or cash flows right now to fund its portion of the equity here, right? If you do the math here, I kind of looked at it. Maybe I can just walk through it right now. If I look at the cost for trains 1 through 3, yeah, so this one here, the total cost for Phase 1 was $18.4 billion. Now that actually includes, as I said, sort of a higher cost per ton. Those first 3 trains are 17.6 million tons per year. That's the capacity of them. So if I go 18.4 billion divided by 17.6, that's about 1.04 billion per million tons per year of capacity that they actually, are able to export. So if you then multiply that out by, I think let's just round it off and say it's 5. I think it's 4 point something. I think it's slightly below 5, but let's just use 5 as a number right now for the capacity of Train 4. So that would come out to about $5.22 billion. However, the full amount, as I mentioned, for Train 4, not the full amount, the amount per million ton per year capacity for that train should be less than it was on a ton per ton basis for trains 1 through 3, because that included this common site infrastructure. And I don't know exactly what that is. They don't disclose it. But what I used was Tellurian, which had also contracts with Bechtel. They had a site which they're not using all the same technology, so it's certainly not exactly the same or like incredibly close, but it's pretty close. And again, similar overall capacity for the site, around 27 million tons per year. Similar capacity for each of these individual trains that they are actually that they're building. And so the thing that I'm looking at here is how much less some of these future trains were in order for them to actually, construct versus the initial contract that included that common site infrastructure. And you can see this here with Tellurian, where stage one, which was they call them plants, not trains. Trains 1 through 1 and 2, 11 million tons per year. The cost per ton, at the time, and these are outdated numbers. These are not their current numbers. I don't think they've disclosed these anymore, but they did back in 2020. They disclosed these numbers, and it was $710 per ton for the first 11 tons, and then it was 500 and 510 and even 390 for the last ones. And again, these are all per ton numbers. It's not like, oh yes, this number was lower because it was less overall tonnage. That is already a per ton number. And so you can see that there is a lot larger costs when they included that common site infrastructure, as you would expect. And so I sort of use these numbers to say, well, it's somewhere between 20 to 30% lower for the cost for these trains 4 and 5 versus the initial trains 1 through 3 of Rio Grande that include the common site infrastructure. And so if you look at it from that perspective, I think you multiply that by 80%, and you're looking at somewhere like $4.2 billion. I think for some of my numbers, I looked at oh, sorry. And so I used this on an EPC ton basis, and I did a couple other calculations, but it gets to my calculation I used was a little bit more complex, and this includes a little bit more. But just using these numbers here, you can see that's even about $4.2 billion. I think the number that I ended up getting at was somewhere around $5 billion, because I included a couple more things and some contingencies. So I figured $5 billion roughly, somewhere between 4.5 and $5 billion for a train for all-in cost. And so if you look at that, let's go back to the actual NextDecade numbers. Hey, Transient Stacker, thanks for hopping on the stream. So if I go back and look at their plans for Train 4, and they disclose that they're looking to do 75% debt, 25% equity. Let's just use sort of a conservative number, say it's $5 billion for all of Train 4, and then 25% equity. That's $1.25 billion in terms of the equity that they need to raise. Now, they're also getting partners in this, as they had partners for phase 1. They're going to have partners for Train 4. But they say, they are expecting to actually fund themselves 40% of the equity, right? And so there's another slide down here that talks about the options that some of their equity partners in phase 1 also have options to purchase equity in Trains 4 and Trains 5. And I think that slide, I'll recognize it if I see it as I'm skimming through. Yeah, so it's this slide here, they talk about, not this one. It talks about, what options some of these folks have in their future, potential long-term economic interest in Trains 4 and 5 expansion. Since they talk about these, they have some of these here. And the point is, going back, talking about phase 4. Sorry, I know I'm jumping all over the place here. That's not even the slide I wanted. This one here. So they themselves are expecting to fund 40% of the equity for Train 4, and then presumably also for Train 5, although they haven't talked about that, right? We're only focused on Train 4 for now. So if you multiply that out, figure $1.25 billion of equity is needed for Train 4. 40% of that is going to be about $500 million, or $500 million that NextDecade themselves has to fund for Train 4. And so this is one of the things that I really wanted to hammer home for anybody who's watching this and cares about this sort of the details of where this company's at, is they are working on Train 4, but they don't have the money right now in order to fund their portion of this. And so they're going to have to get $500 million from somewhere for Train 4. And the most likely place, I think, if you look at history, they call it out here. They say they're exploring multiple options to fund that and will select the best available option at the time of financing. Seems pretty likely to me they're going to do an equity offering similar to what they did in order to fund their portion of phase 1. And so you just multiply that out. We about $500 million they're going to need, and divide by, if they get a share price of $5 per share, that's another 100 million shares that are going to be outstanding. That's a pretty substantial increase. And maybe they'll find something else. Maybe they'll be able to get some debt at the NextDecade level rather than at the Rio Grande level. I don't know. I think they do have future cash flows from, trains 1 through 3 that they were able to use as collateral for some debt. But we'll see what they do. As my base case, I'm assuming they're going to just get, full on equity, just dilute the common stock. And if that's the case, as I said, you're looking at, somewhere around 100 million shares. If they only got, so again, it's $500 million they need to raise. If they only get $4 per share, that's 125 million shares. If, they're able to maybe announce some agreements for other equity partners, agreements for sales and purchase agreements, to actually offtake LNG. And, if that pushes the stock price up, if they dilute at, $6, $7, or even $8, that's going to be less, right? I think at $8, that gets you, that cuts it in half, from the 125. So I think you're down to, as I was thinking, 62.5 million shares. And so there's a bit of an unknown in terms of at what price will they actually dilute. When they did this with Total, I think they diluted at slightly below what the stock had been trading at for a while. I think they diluted at, just under $5, like $4.98 dollars per share, if I recall. And so, it's not unexpected to me that they would do the same thing, and that they would actually even go back to Total and say, hey, will you purchase some of our, stock the same way you did for phase 1? We'll see what happens. That's my base case, and that's how I modeled it out today. I think, if they're able to find something that's less dilutive for common shareholders, it's probably only going to be further upside for the stock. And so, again, in my models, I'd rather be a little bit conservative, or at least try to be conservative. So that's how I'm going to model this. Let me see what other notes I had to go through before I get into my actual DCF model. Oh, one other thing to mention, so let me get to their actual Q4 results, right? So I'm talking about what the company is looking at now, but if you look at Q4, this is actually their full year results. But so if you go here, their full year results, this is their statement of operations, and you can see even in Q4, because of their full year, they generated $0 in revenue. Not unexpected. They have nothing right now. They've made their FID, which means they are paying money to construct the facility, but they're not yet generating any revenue, because they're not yet generating any LNG. And so they're not going to be making actual revenue until probably 2028. So then that begs the question, they are actually still spending money. They've got G&A expenses. And so the question is, how are they funding all of this stuff? Partially they're paying, their employees a little bit in stock, but they are paying them some cash. And I did an estimate. And so for the state that they're in, it's a little bit interesting because I don't know how much of this is actually split out between NextDecade and how much is split out to Rio Grande LNG or Rio Grande LLC, whatever the corporation is that owns the Rio Grande facility, because presumably there's some G&A expenses for that, and some of these other bits here actually are attributable to that subsidiary rather than to NextDecade. And there's plenty of cash for those things that's already planned in, right? Those things, if I go up to the balance sheet, you might look at it and see, hey, they've got $38.2 million in the balance sheet. That's not much. But then you say, but they've also got, $256 million of restricted cash. And that's quite a bit more, almost, about 8 times as much. And so that is restricted because it is actually held at the Rio Grande LLC level, or whatever that, again, subsidiary is only to be used for, the Rio Grande facility, not for the NextDecade Corporation that is the parent company, the one that we own stock in if you're a common stockholder of, ticker NEXT. And so effectively, NextDecade, the corporation, only has $38.2 million on their balance sheet, or at least they did at the end of 2023. And they are still burning money. And in order for me but because, again, this is a consolidated balance sheet, this is both the NextDecade Corporation and the Rio Grande all consolidated into one, it's a little hard to know precisely how much they're spending. And so I actually read deep into this, or read their full 10K, read through their full, prior quarter 10Q. And what I did was actually did sort of a difference on their balance. I subtracted balance sheet items to not guesstimate, but sort of actually calculate how much should they burn in terms of cash at the NextDecade Corporation level. And so what I did was I looked at their cash and cash equivalents. So let me sort of go. I closed the actual 10Q that I wanted to go to, that I wanted to show you. But you can just trust me that these numbers were pulled from the end of Q3. 10Q. So they had about $50.8 million of cash on the balance sheet, prepaid expenses and accounts payable and stuff. So I looked at their current assets that I thought were relevant and current liabilities I thought were relevant. They looked at what their cash burn was quarter over quarter, right? And so they went from about 50.8 to 38.2. And so just on balance, that is, what's that? Roughly $12 million of burn. I guess it's 12.6. I have the number right here, right? This column here is the change from the end of Q3, the end of Q4 for their balance sheet. So I think that's about $12.6 million of cash burn. I also made some of the adjustments that you would normally see on like the cash flow statement to back out changes in balance sheet items, because sometimes you might run up your accounts payable, meaning you didn't pay it yet, but you're going to have to. And so I wanted to normalize this to have a rough estimate of their, what their theoretical cash burn is, each quarter going forward, so that we can estimate how much runway do they have, how much money they're going to need between now and 2028, when they're going to actually start bringing in revenue from Rio Grande LNG, that some of that will funnel up to the NextDecade corporation level and allow them to actually fund their operations as they are. But in the meantime, they're going to need money. And so I looked at their cash burn. Their actual cash burn was $12.6 million. I adjusted out, as I said, the differences in their just these couple line items here on the balance sheet, assets and liabilities. And in the end, I got to an adjusted cash burn rate of about $12.4 million. Sorry, these figures are all in thousands, as you see on all their quarterly and annual reports. It's about $12.4 million of cash burn. It's pretty convenient. You multiply that out over 4 quarters in a year, and that comes out to almost exactly $50 million of cash burn per year. So it makes the numbers very, very easy. And so if you look at that $50 million per year, they're going to have to do that for 2024, 25, 26, and 27, right? 4 years until they start operations, at the end of 2027. Presumably 2028 is when they'll actually be able to fund the company. That's when Train 1 should be up and running. And so you look at that, and they have a shortfall of $200 million of cash just for funding their general operations they're using to, develop Trains 4 and Trains 5, get the SPAs in place. And also, as I mentioned, I alluded to before, everything they are doing, all the expenses they're incurring for the carbon capture side of the business, that is not yet generating any revenue to my knowledge. Well, I guess so far it's not generating any revenue. The timeline for it generating revenue is unknown. Maybe that will start up in 2024, 2025. It's really hard to say. They haven't given a lot of transparency on that side of the business. But for now, I assume that whatever they are doing was included in this particular cash burn, right? So again, trying to be conservative in my model, that I'm building and how I value things. This includes none of the revenue, but all of the expense, at least so far. And so, again, $12.4 million of cash burn, $200 million between now and when they start full operations. I modeled this as something else that they're going to have to actually dilute in order to raise the capital for. And I don't see a whole lot of other options. They did, and I'll mention in a moment, they did start to get some debt, but the fact that debt was not large, and it was sort of a revolving credit facility, makes me think that sooner or later they're going to have to do some dilution in order to actually, keep the company running. So once again, maybe $200 million, if they dilute this at, $5 per share, which is roughly where it's trading now, that's another 40 million shares they're going to have to, come onto the balance sheet and dilute all the rest of us, in order to fund this. Now, they may wait and, if they're going to do some sort of a private placement transaction, as I mentioned, like they did with Total, in order to fund Train 4 for their equity portion, it's quite possible they would just tack this on, right? Because if they need to raise $500 million in order to fund their equity portion for Train 4 for Rio Grande, it's not that much more for them to say, you know what, I don't just need 500 million, I need 700 million. Give me the extra 200. And the extra 200 they will use for their corporate, purposes to fund the company between now and 2028. They would just do one large raise, get it all done and over with. And so that would be kind of, I'm not going to say nice to see, right? I don't like to see the dilution, but it would be good to see them actually come out, get that transaction done, and, have the certainty of the line of sight of what the company is going to, how they're going to fund the company between now and, for the long term. So that is how I'm modeling it out. I think they can, in reality, probably do better if they're able to get an FID on train 4, and then they're able to, get the stock price to go up to 6, 8, maybe even $10 per share and dilute at those levels, obviously that's going to be a lot better. But, it's, I think the market is looking at the same thing I am and saying, sooner or later, you're going to have to raise money. We're not giving you a premium valuation until you're not in need of cash, right? And so that's my kind of read on things. My read on why I think the stock is trading where it is, and why, for a while it was trading even under $5, even touching down in the mid fours. Anyways, so that I think is a decent statement on sort of like all the money they're going to have to raise, and just be aware of that if you are invested in the stock or considering investing in the stock. Like they are not done raising capital, and again, they could do some of this through debt, and they did do let me find the actual revolving. So they did get this revolving loan facility. Let me find the actual announcement. Well, this is at least a headline here. January 2024, they executed a credit agreement because of a $50 million revolving credit facility. And again, they said they can use this for whatever, right? General corporate purposes, working capital requirements of, again, the NextDecade Corporation. And they said, including development costs related to the 4th liquefaction train and related common facilities at the Rio Grande LNG facility, right? So it's pretty clear they're at least getting this money for now. They got $50 million. So add that to the $38 million that they had at the end of 2023. So now that's more like $90 million. And again, as I sort of calculated, the $50 million is enough to fund them for a year. So they're not in any dire need of cash. I think that does fund the company for another, roughly the cash on hand they have is for about a year and a half, right? And so that I think is a pretty good amount where they're not in dire need of cash, but they still don't have the runway, as I mentioned, to go all the way to 2028 yet. That's going to happen from some future transaction. So, all right, I think that's a decent overview of what's gone on. They have actually had a couple more announcements for debt. They've been sort of, I won't say refinancing, but they've been getting some longer term debt. And initially, when they did the FID transactions, they got, I think, a 7 or 10-year loan for the debt portion of Rio Grande Phase 1, and chunk by chunk, I think by about $250 million here and such. They've actually done a couple. Let me see if I can find one. I think interest rate. Yeah, so they've done a couple of these transactions so far. They call them their senior secured notes, where they're taking over. One of these was $700 million, $356 million, $251 million. They're slowly getting these notes. They're refinancing them. I guess no, some of these must have been their. Those are only the 10-year notes, but this is some of the newer ones. Sorry, my bad. Excuse me. This was the first tranche of them where they said we got some notes at 7.11% that now we're pushing out the maturities and that all the way to 2047. And again, that was about $250 million. I guess this is probably under subsequent events because they did them. I think they did this in early 2024. Yeah, additional Rio Grande senior notes. So they did $190 million at 6.85%. That was back in February. And then they did, I felt like there was another transaction. Maybe I'm missing it here. Anyways, they're doing this chunk by chunk to sort of get their maturities further out. I think sort of get fixed interest rates for these that they know they can actually have clear line of sights for the business for the long term, right? To align it with what they have for phase 1 in terms of their SPAs, right? Because those are 15 to 20 years and all that. And so I think that is something that we're going to continue to see. I don't really have a strong opinion on these. I don't think it makes a big difference. Kind of what we all expected, where they're going to refinance it. So we're not going to have all this interest, due in only 10 years. Like that does not really align when they have cash flows that they have line of sight on 15 to 20 year cash flows. So it just makes sense for them to get this new debt that's going to go out even further and sort of let them have just a long-term operating business. So let's see. Let me go ahead and go on to, I think, my valuation model. Yeah, I guess one other note that I was going to mention before I go on to that is very, very quickly is, as much as they're talking about a train for FID that they're targeting, the one thing I will call out, and I've mentioned this a couple times before, I don't know if I mentioned on my channel or not, but in talking to people, this is their 2023 proxy statement as the executive compensation. And they call out here that there were performance awards that people got. What were they? What does PSU stand for? Performance stock units, I think. But basically, these folks had to make something happen in order to actually receive the stock that was their awards for, in terms of some of their executives. And you can see down here we had, this is the CEO, the CFO, and what's it, the general counsel? Sorry, maybe I'm missing. I don't remember. General counsel. Yep, I was right. And so they had these Train 3 PSUs, meaning these were stock units that were granted to them. They're going to actually vest when they got an FID decision on 3 trains of Rio Grande. Now they've done that, and they still have some other performance related stock units. These are actually based on the stock performance. Most of it is based on how does the stock perform basically by August of 2025. And if the stock is less than $11 at that point, they get nothing. And so that's pretty nice as a current shareholder to say, hey, if I buy at around even $5.50, they have to double the stock in order to get any of these performance related stock units. And in order for them to get all of it, they have to make the stock almost 4x from these levels, at least 3x, almost 4x from these levels to $20 per share. And so that does give them some decent incentives to reduce the dilution, or at least to maximize shareholder value, right? So this is, even though their personal ownership at the current moment may not be huge, although I think they actually their ownership is fairly significant, because I don't think anybody made large sales after getting these Train 3 PSUs. And so these are hundreds of thousands of shares, 700,000 shares for the CEO. CFO is 234,000 shares. And so these are not small numbers. So they do hold quite a large portion, but they have even more that they can get, about half of that amount that they got for Train 3 FID, they can get in terms of total stock return PSUs in the future. And again, to get the maximum amount, they have to get the stock up to $20 per share by August of 2025. So that's one thing to keep in mind. But what I want to call out on the flip side, none of them have specific PSUs, as far as I can tell, that are tied to Train 4 or to Train 5 FID. And so that is one thing that, I think would be nice to have seen some of these PSUs actually split up across all of them. Maybe if it was 80% for Train 3 and then, 10% for Train 4 and 10% for Train 5, that would have given them, even further incentives to actually continue on with Train 4 and Train 5. But, it is what it is. Just something to keep in mind. Oh, sorry, I see a question on here. How would you compare, Transient Stacker asks, how would you compare Next and Tel? So, that's a loaded question. But, I would say NextDecade is, at this point, I think just in a better state altogether. I think it's lower risk. I think, and potentially even higher reward. I'm not going to necessarily say higher reward, but, I think NextDecade, I think Tellurian has put themselves in a tough spot at the moment. And so because of that, I think even the upside is to some degree limited, because they are just in such a bad, starting place. They're not out of, they're definitely not going bankrupt tomorrow. Tellurian isn't. And, they have, a path to actually do quite well, from the, where the stock is at right now. And potentially because of, I think around, at the current valuation, where it's somewhere around $1, I think maybe 90 cents or something. I think since the integrated model is gone, they are selling their upstream assets. They are looking to then just go on with standard tolling contracts. I think they are clearly behind where NextDecade is at. On the flip side, they did invest more. They've already invested more money in their, what would be their phase 1 than what NextDecade did in there. So that's one thing to keep in mind. That is sort of in the favor of Tellurian. On the flip side, Tellurian is still, diluting at fairly low levels, and they have 700 million shares outstanding, so like 3x the number of shares outstanding. Let's say they haven't sold their upstream. There's a lot of, unknowns in terms of how much they're going to get for that and what they're going to be able to do with that. They do have some sort of threshold or cliffs, as you would say, in I think October of this year, where they really have to get something done by that point. in order to pay down, some of the debt that they have. And Tellurian has a lot of risk in it right now. I think it's reflected in the share price. If they execute well, Tellurian could be a higher return over the next, certainly over the short term, right? Because I think right now it's fairly, there's a lot of pessimism built into the price of the valuation of the company. But they're not starting these things from a very strong negotiating position, right? I think that's kind of how I would contrast them a little bit. I think NextDecade clearly has a line of sight. They are going to have to do some dilution, but the dilution is, it's capped and it's known. They're going to have to raise this. And, NextDecade stock, when they say, hey, we have to dilute, they're not going to drop to, I can't predict the future, but it seems highly unlikely that they're going to drop to even, $2 or $3, right? They've got, they're positive FID. They've got partners, they can go to them, even if they're not, ideal terms. They've got people that I think would give them money to see this project continue on and move forward without a lot of drama and, issues. So I think NextDecade is just in a lot lower, they're in a lot lower risk position right now. And they're also, in the position where they've already funded, I sort of mentioned this, where they've already funded these more expensive earlier portions where they've included some of this common infrastructure. And so now, even if they're competing for the same sales and purchase agreements from, off-takers, NextDecade can accept, the same fee, but get a lot higher profit margin on it, because right now they're eyeing their sort of, their brownfield expansions on top of their site, rather than, starting with the cost of the full site infrastructure and such. I know Tellurian has already paid some of that, but I mean, it is included in what they have to, in the math for these things. So that's my top of mind thoughts. I don't know if you have anything in particular you were asking about, or that you'd want me to give my opinion on with that. Anyways, all right. So that was just one thing I wanted to call out with their actual, executive, with the NextDecade's, sort of how they are incentivized, where they don't have direct incentives for Train 4 FIDs like they did for Train 3. So just something to keep in mind. Now, if I go through, here's my my discounted cash flow, model for this company. And again, let me give you the preface. This is not financial advice. I'm not making a price target. This is just giving you a model showing you how I personally am modeling, the stock, and kind of coming to my conclusion about how much it's valued and what might be fair value in the future. All right, so I've got quite a bit here. Roughly what I did was I'm modeling trains, 1, 2, and 3 in, sort of this column here for every year from 2024 onwards, and looking at how much free cash flow do we expect to get from those trains. I also modeled out, they do have some uncontracted volumes. This isn't something they've mentioned. The company itself, if I didn't mention it on this stream, I'm sure you're familiar if you've covered the company in detail yourself. Read their investor presentation, and they project out distributable cash flows from trains 1 through 3 of $200 to $300 million per year, average over 20 years, and then for trains 4 and 5 combined to be about $350 to $500 million per train, coming out to $700 million to $1 billion, for trains 4 and 5 combined. And again, that is those two add up to be, it's $900 million to $1.3 billion per year in distributable cash flow. I am using roughly these numbers, but then just putting the timing on it and, a couple other bits that I add in here. But there's a footnote here that's interesting, and that is that, this number down here, probably can't zoom in quite far enough for you to see, but basically this is only based on their 16.2 million tons per year of contracted volumes. There is a little bit that's uncontracted. They called this out in their uncontracted volumes in their 10K. This is buried. They certainly didn't emphasize this in their press releases. I only saw this down in their actual 10K, where they said, Rio Grande expects to sell any both commissioning volumes and operational volumes in excess of SPA volumes, meaning whatever we can produce that's over and above what we sign contracts that people are requiring to take from us. They're going to sell that into the LNG market, at spot, short-term, medium-term agreements. And if you look at this, trains, 1 through 3 is 17.6 million tons per year. That's what the capacity is. However, they only contracted 16.2. This is 16.15. I guess maybe that's even slightly more precise, but 16.2. Let's round it off. That's the number that they use here in their investor presentation. They say, hey, this distributable cash flow is based on only that 16.2. That leaves almost 1.5. I guess it's 1.4 million tons per year that they can sell at spot, and that I think they're going to get they could potentially get a much higher margin on that. And I also modeled this out, right? So I modeled this out in my DCF as if they got $4 per MMBTU spread rather than what they normally get, I think, on their fixed tolling contracts of just about $2 or just above it, right? Maybe 2.2, 2.3, somewhere in that vicinity is probably what they have for that full 16.2 MTPA that they've contracted. So that remainder of that 1.4 MTPA could be fairly lucrative. And so that's something that I think is not reflected in these numbers of distributable cash flow, but that I did include in my valuation model. And so I put that at, as I said, a $4 spread. It could be even wider, that's going to be very volatile. You look at, I actually opened up the futures, current future pricing, most recent pricing for JKM, about out to 2029 here, and it's $7 to $8 range. I think $4 of a spread is probably reasonable on that. But these numbers have been higher in the past, and you can see there's some numbers 2026 they're you don't necessarily expect futures to give you the actual price, but it's complex, right? But I think $4 is a decent, conservative, even ballpark number for that. So I think this is a fairly credible estimate of what cash flows they could get from their uncontracted volumes from train 3, basically. And then I have, of course, my discount factor to get back to net present value. I also modeled out trains 4 and 5 free cash flow here. And at present, I'm using their lower numbers. They expected, as they said, $700 million to $1 billion per year for trains 4 and 5. I just used $350 million per train for trains 4 and 5. And I assume they are actually using the full nameplate capacity of those trains. So there isn't any separation between their, contracted free cash flow and uncontracted free cash flow. This is just, I assume the numbers that they had there already factor in whatever they're going to be able to do with those trains. And then I just add those up. That gets me to current net present value from the cash flows from each future year. Get that back to today, and you get a valuation. I also factored in what year are they going to start, and I put train 1 to start generating full revenue in 2028, and trains 2 and 3 I think in 2029. If you look at their time frame as they've currently called it out, it's pretty clear that let me zoom out a little bit so you can see this. Train 1 should finish at the end of 2027, train 2 in mid 2028, and train 3 in sort of the end of 2028. To keep my model just slightly simpler, I just said train 1 finishes in end of 2027 and then is operational in 2028. Trains 2 and 3, I just said you can just end in the end of 2028 and then be operational in 2029 for the full year. So that's probably pretty close to reality. I don't think there's a big difference from that particular assumption. And add all of that up from trains 1 through 3. Again, I put sort of the minimum, the lower end of their discounted distributable cash flow numbers of $200 to $300 million. I just put in $200 million here again to get a conservative valuation, and put in trains 4 and 5 to start in 2031, 2032, 10% discount rate across all of it. And I used a 10 price to free cash flow multiple on to get sort of terminal valuation at the end of the period. I modeled out the cash flows for 15 years roughly, and then said at the end of 15 years, what is sort of an estimate of the value for the company at the very end. Add all that up, put in the dilution from funding operations for a couple of years. I put in 40 million shares of dilution. That's what it would be if they raised $200 million at a $5 per share valuation. I also put in dilution in order for them to fund their equity portion of trains 4 and trains 5. And so I put in 100 million shares for trains 4. And I assume slightly lower dilution for train 5 because hopefully by that point the stock price will be higher than it is today. It would be more like $8 per share. So that would get you down to 62.5 million new shares. Add all that up, you're looking at 462.5 million shares outstanding by the, because they currently have about 256. I rounded that up to 260 to account for some of their stock-based compensation. So that's my sort of final share count after, in 2028, and probably by that point they shouldn't need to do a whole lot of new dilution because they'll have cash coming in the door from Train 1, and so they ought to be able to fund the sort of the corporate portion of the company just from those cash flows. So all that to say, I think if you factor in Trains 4 and Trains 5, current fail value, again, this would be at if they FID Trains 4 and 5 tomorrow. So this is not necessarily current state of the company, but if they did, that would be sort of a current valuation of $11.76 at the low end. Again, using low estimates for their cash flows from basically all trains, and so that's where it's at. Now, if I look at only Trains 1 through 3, so I can do that number as well. Let's assume they never get FID in Trains 4 or Train 5. So make these cash flows for Trains 4 and 5 0. And then if I also look at, so then if we do that though, then dilution due to Trains 4 and Train 5 equity comes down to 0 because they don't have to raise the equity portion. They never actually get the FID. Current fair value just on phase 1 at the lower end of their free cash flow estimate from the SPAs is probably somewhere around $5.77, which is pretty close to where it's trading at today. Over the past month or 2 or 3, it's been, at quite a bit of a discount from there. Maybe even now it's a 10% discount from that, but it's not a huge. Hey, I see a question on here. Thatcher's World asks, do you see any risk for Next if Mexico gas demand picks up? Will the pipelines prioritize gas movement to Mexico versus Rio Grande? I've not seen mention of this in 10K, but it could be a risk. So you are that is a risk right now. They do have 4 years, right, to source their gas. There was a mention in the 10K of they're looking to sign. Where's that? So first, there's a mention in the presentation, and also in the 10K. I can find this. But they did call this out somewhere. Let me find the right slide. Sorry, give me just one moment. It's this one right here. So they already have the pipelines that can transport it, and they're hooking into a second one, the Valley Crossing pipeline. But if you look here, and I'm sorry, I'm going to use that right here because it's right here. This is the mention in the 10K where they said we have proposed and are in the process of executing, a substantial and diversified natural gas feedstock sourcing strategy, right? And so they are looking to actually, we expect to enter into gas supply arrangements with a wide range of suppliers. They're doing some other stuff for trading to sort of hedge their risk in price there. But they are looking to actually do that now. Again, they don't need the gas for quite a few years, but they are looking to actually sign contracts to source gas. So it is currently a risk because I don't think they have those supply arrangements in place today, but that is something that they are aware of. They're looking at it, and I would imagine that they're going to start signing these in the next year or two, and so that it's a risk that they've mitigated, years in advance of when it actually becomes a big deal. And I think, again, part of that signing or getting connected to this second pipeline here is also nice because that gives them even more options to source gas and even more options to sort of optimize sourcing the gas in a lower cost manner, right? One other note there on that, they did call it, because it's in the very next paragraph here, some of their actual people that they sign SPAs with, they have the option to actually source the gas, to send it from them themselves, and the specific language here is, they have the option to sell to Rio Grande some or all of the natural gas required to produce the respective contracted LNG volumes, right? They have to give them some notice and say, here's how much we're going to provide to you. Here's how much we're going to have to source for you. But some of the people that they sign SPAs with, presumably, I guess, Shell is probably one of them. If you look at these, you can see, Shell is probably one of them. Maybe Exxon and maybe Total. I don't know, but I think ExxonMobil was the I want to say that was like the Chinese subsidiary, if I recall correctly. And so maybe not, that had some portion of it. I don't know. I don't know if Total owns any gas operations in the U.S. I only say that because they're such a large corporation. They probably own stuff all over the place. But again, so some of the gas they may not have to actually source because they may be supplied it from some of their off takers. So it's hard to say. But yes. They are aware of that. They are working on that, and so that's a thing that I didn't call it out here because I don't think it's going to be hard for them. But I expect to see some agreements at some point in the next year or two. Again, they've got until 2028 until this really becomes a problem for them to not have firm sourcing for gas. But so that is, sort of my thoughts on that. Hopefully that answered your question. All right. Let me go on with the DCF model here. I can go through a couple different, scenarios. Sorry, I'm trying to get the live chat back up on my phone. There we go. All right. So yeah, so this is my valuation if they only ever do trains 1 through 3, never move on to trains 4 and 5, which I think seems unlikely given the LNG market, given the strong partners they have that already even have options in trains 4 and 5, but that's sort of current price. Now, if they also only did that, we looked at their, final, free cash flows in, by the end of, 2029, we're looking at $258 million per year. If we just looked at sort of a relative valuation at that moment in time, we'd be looking at a share price in 2029 of somewhere between, again, this is not discounted cash flow. This is just if I take their cash flows in that year, $258 million per year, divided by my shares, my estimated shares outstanding of 300 million shares. I'll run through the calculation, $258 million in free cash flow, and divide by their 300 million shares outstanding, give them a 5 multiplier. That's 4.3 share price. If they have higher price to free cash flow multiple, depending on what the market wants to value them at, I think 5 would be on the lower side of what I'd expect. That's why I have it as the lowest one here to model. Because they have 15-year to 20-year contracts. This is a commodity that they are hedged away, right? They're getting just sort of fixed fees on all of this. Seems unlikely that they would get a particularly low multiple, but I don't think they're also going to get a high multiple if they are not able to grow, right? This is a fairly sort of like a stable operating company, and so I think somewhere between the 5 to 10 range would be where I'd expect to see it. But anyways, if you look at that gives you a share price in 2029 somewhere between 430 to 860 if they only ever do, phase 1, which is trains 1 through 3. Now, again, let me go back to this and say if they're able to get, let me put trains 4 and 5 back in here. If they're able to get trains 4 and 5 going, those, again, as I mentioned, start in train 4 in 2031, train 5 in 2032. And then if, they have to dilute in order to actually raise the equity for that, they dilute, and in the end, they end up with 462 million shares outstanding. The current net present value, given all of that, and again, assuming 462.5 million shares outstanding, that would get you a current value of more like $11.76. And if I were to look at sort of a 2032 price to free cash flow, because by that point, their free cash flows is also going to include in the $700 million from trains 4 and 5. So you're looking at roughly $1 billion. And free cash flow, you're looking at 2032 multiple at 2032 price free cash flow multiple 5 gets you to a share price of, $10.36, with the range all the way up to, 20 and even 30 if they had a sort of premium price to free cash flow multiple. Now, this is still using the lower end of their discounted cash flow, the distributable cash flow projections. If we even use the midpoint of their ranges, right? So if we go 250 for trains, 1 through 3, and we do, 425 for, trains 4 and 5, that pushes up the valuation significantly. I think current, fair value at, not current, but fair value at sort of train 5 FID goes up to, more like $14 per share. And, looking into the future, you're looking more like $12 to $37 per share for a reasonable range, probably more like 17 to 25 is what you'd actually expect. And then if we use even the top ends of their ranges, which is not impossible, use that there, 300 for trains 1 through 3, and use a 500 per train for trains 4 and 5. You could look at, a lot higher valuations here. Current at FID for train 5, per share price of, $16.70, something more like, closer to $20 to $30 in 2032. That's kind of how I view it and how I'm modeling out the company. So that's sort of the full range of, outcomes as I see them. I take from this a conclusion that I think just with trains 1 through 3, they are fairly valued, and we'll probably see some appreciation. I personally think trains 4 and 5 are fairly likely, at least train 4, if not train 5 also. I think it's just sort of dominoes falling, because they. Anyways, not going to go too much detail there. I've already rambled on for quite a while, but I think these are likely, and as time goes on, we're going to see that happen, and the share price is going to appreciate even as they have to dilute. Right? I'm not assuming no dilution here. I'm assuming that they almost double their shares outstanding between here and train 5 FID, and so I think even still you can see some pretty significant upside. If they're able to hit close to the top of their ranges here. That was everything I had to go through today. Hopefully that gave you some, insight. If you have a question, let me know. Let me know in the chat. I'm gonna, stick around for another minute or two, and then I'm gonna probably hop off if I don't have any particular questions or comments. Thatcher's World said a couple minutes ago, I appreciate the answer, and I'm personally bullish Next. Agree they have plenty of time to work around the issue. Very minor worries from my end about Mexico priority for pipelines. Thanks. Yep, absolutely. And it's a valid question, right? These are the sorts of things that, I think are. As a diligent investor, you have to really think about these things and sort of, because it's not that the company isn't going to manage these things. It's that those additional risks or those small details here and there that are actually very important. Sometimes those can be the sources of, negative returns for common shareholders, right? Like maybe they had a way to do this, but, certainly they have a way to source the gas. I mean, that's not really a great example, but maybe if they didn't sign up for those things, it might be sort of a hidden assumption that the company is making. They say, hey, we're just going to source it from spot in the future, and maybe they're not able to. Maybe they do a bad job sourcing from spot rather than getting these agreements, and they're not very hedged, and so that could actually push down, profits in the future in a way that disproportionately affects shareholders, but not necessarily management themselves. Management is still going to get their salaries, as long as the company can pay them. So I think it's really important to actually go through all the details as an investor. All right, Thatcher's World. Let's see. Why is the market sleeping on the significance of the most recent FERC approval? Sorry, I'm not exactly sure what you're asking. I think if you mean like the fact that they have approvals, they have spare capacity, and that FERC has been pausing, future approvals, and I think it's not necessarily the FERC approvals that they pause. I think it's the DOE, the exports, but I mean it's functionally similar. Maybe that's not your question. If I'm getting it wrong, sorry. Please, feel free to correct me in the chat. But I mean, I think it's still just even with that kind of tailwind for these LNG export facilities that are trying to get things together and move forward, there's still a lot of things that have to go right in order for that to happen. So while that is one small sort of check mark in the positive category for a lot of these companies, there's still a lot of risks that happen, a lot of things that as I said, that have to go right in order for them to actually move forward. And so I think it's I think that's really just why the market didn't give a huge premium when they recognize that that's what's going on. That's kind of my take on it. And again, it's not like they are the only ones out there that are able to do this. I also think, you could see, timing does matter as well. Like NextDecade has trains 4 and trains 5, but they're not going to be able to deliver that LNG until, presumably 2029, 2030 at the absolute earliest, if they finished all the paperwork tomorrow and got Bechtel going on it. And so I think that's another thing just to consider, where even if they have spare capacities for quite a ways in the future, is anybody really rushing to get LNG, 5 years from now? Maybe not. I don't think they're in any rush for that. And so again, I don't think the market is going to give them a premium for that, even if the overall capacity is limited. There's no one company that has, we are the only ones who can export LNG. I think at the current moment, if I understand correctly, I think Tellurian is probably the one that has the soonest ability for free capacity to export in probably the 2028 timeframe. But again, that's still a lot of things have to go right in order for even that to happen. So that's kind of my take on it. All right. Stick around for 1 minute, see if there's anything else in the chat. Otherwise, I'm going to hop off. Just to sort of mention, I do these streams every Sunday. I do them live. Try to do it mid-late afternoon, usually around 4 or 5 p.m. Eastern U.S. time on my channel here. So I talk about stocks, sometimes Bitcoin. Kind of what you see here today is similar stuff to what I'm going to talk about for most times when I cover a company. I like to make discounted cash flow models. I like to read through all the details and kind of get an idea of what's coming up for these companies. And yeah, that's basically it. All right. I don't see anything else on the chat. Really appreciate everybody hopped on today. Thanks for watching.